Right. Welcome everybody to Midas Investing Live. Hope you all have had a good afternoon. Happy Friday afternoon to all of you out there. Also, the last trading day of the year. A bit exciting, I guess, on that front. Although I would say, I would say today the itself was a little bit unexciting in terms of the market activity. It definitely felt like um, most of the stocks that I was looking at definitely was not super major moves one way or the other. A relatively tepid day, slightly down for the market on the whole, but either way. I thought I would have a live show today, as we've been doing for the last few weeks, kind of peppering them in at some random times, Fridays and Saturday afternoons. We might experiment with some random times in the middle of the week, but I kind of like the idea of doing a show right at the end of the week. So I don't know, maybe Friday might become a somewhat of a favorite day. Either way, in the market this week, didn't do too much in my own portfolio. Really just kind of sitting watching things, doing a lot of analysis and kind of waiting for things. I actually did start to trim one position finally, that being Jackson Financial, one of our smaller positions that we picked up during the regional banking crisis earlier in the year, or mini crisis, I guess you could say. But either way, finally started to trim a little bit on that one. We are up over 50% in total returns since we started that position. We've also had it for less than half of a year, so pretty good return in time on that one. But either way, I had always kind of bought into that one without making a full model for it, so I always kind of assumed that I'd probably be relatively quick to let it go of it. Once I saw some appreciation on it, it was really just way too undervalued and underpriced by basically all metrics I could tell. So did take a position in that, but since it is more based off of relative valuation than it is a longer term perspective on the business itself, that's one reason why I started to kind of let's let go of it a little bit. Now, another one that I didn't actually finally start to trim this week, but I was thinking about it a lot, and I'm probably going to start trimming it next week. And that would be FNF, Fidelity National Financial, one of our more major positions that we've had for quite a long time. As you can see right here, we've had our weighted average holding for our shares are actually about 3 years for Fidelity National Financial. So we've had this position for a long time. This position as well is over 50% in total returns. It's actually closer to 75%. And this is also the company from which FG had spun off of. And part of that 75% is the distribution of the FG shares, just so that it's clear. That's like 4 or 5% of that 75% or something like that. But either way, Fidelity National Financial has been really rocketing upward for the last several months, and so it's actually now at all-time highs as of yesterday anyway. I don't think it moved too much today necessarily. I wasn't looking at it, but the point is I think I'm finally going to start trimming that one again. Now, Fidelity National Financial, as I've said and shown here, I've had that one for 3 years. I have bought and sold this one up and down over the course of that time frame a little bit, so this is definitely one that I've traded in a range, so to speak. When it comes to Fidelity National Financial, I've sold out of a much larger percentage of that position in the past, and then bought a little bit more when it went lower again. Fidelity National Financial was my largest position for a long time, from about midway between 2020 till I want to say maybe the start of 2022. So really not long time, but well over a year, it was my largest position. So either way, pretty interesting. Sheesh, says Mr. Beast. Hey man, how's it going? Welcome to the end of the year show, I guess you could say. But either way, yeah, definitely looking at maybe starting to trim that one, and it is a little bit over my target range for that one as well. So that's definitely one of the reasons I'm starting to do it. Not only is it overvalued by my estimate, it's about 15% overvalued according to my most recent estimate. It's also over allocated within my portfolio, and it's at those all-time highs. So like I said, it's like all in together. Fidelity National Financial is definitely looking for some trimming. I didn't start doing it this week, but probably going to start doing it next week a little bit. Yo, Scott, what's up? Decided to go live today. But there are other positions that we are over allocated to. That's definitely not the only one. We're actually over allocated to a few positions, but I'm looking to adjust my allocation system a little bit again, partially to do with all of the different spreadsheet changes that I've done in the background with my evaluation templates as well as my dashboard. That both of those things together meant that there's now been some changes to the way I transfer information between my spreadsheets. And so as a result of that, that means I have some changes I need to do to this portfolio dashboard as well. And that's going to probably include some tweaking to how I have momentum affect the top range of my allocation system, because that is part of how that system works. And so basically I have more information to use for that. So there's some further sophistication that I can essentially do to that. But either way, my targeting system currently says that I have too much FG, too much Smith & Wesson, too much F&F, too much Interfor, and too much Jackson. While it also says I have too little of Skyworks, Spirit, Meta, Advanced Auto Parts, InMode, a little bit more PayPal needed as well. Yeah. And also, I'm over allocated to cash, of course. I did end the year with my momentum strategy, by the way, ended in a neutral position, which is pretty interesting considering it was relatively bullish for quite some time now, but for the last couple of days it's kind of been teetering between the very bullish signal and the more neutral signal. So we'll see whether or not that neutral signal decides to slide into a bearish signal or not. Usually it requires a couple more days before it to really get a full confirmation for that, so we'll have to see there. Scott asks, 12% InMode would be risky. Well, I think it kind of depends on what we're talking about here. So I assume you're kind of looking at this this big needle right here that's around that 12% point. As I've said before, this is supposed to include capital appreciation. So what I would say is that if you allocated fresh capital all the way up to 12% for InMode, I would say that's a bit risky. But if you allocated up to maybe like 5% InMode and then capital appreciation brought you to 10 to 12%, well, then I wouldn't say that's necessarily too risky. That would be the point where I would still consider maybe starting to trim a little bit of it. But the point is you know, because of the fact that it would be the gains themselves that kind of de-risks it a little bit to a certain extent. So it kind of depends on your perspective of just how much of it is house money versus table money in that sense. So, you know, kind of depends on your perspective of it. I'm currently at about 3.6% InMode for what it's worth, and my targeting system says I should have at least 4%. And then as you kind of pointed out, it says that at a max range, I should maybe allow it to go up to maybe about 12.5% or something like that. So definitely a lot of runway is allowed for that one in terms of capital appreciation because it's partially expected there. So that's the way it's going to be. Wait, it's going to run spawn? I'm not sure what you meant there, Mr. Beast. Yeah, I was seeing that PayPal pullback. I didn't buy any today, but I was seeing that was basically the only thing that looked like it had a real substantial dip today. Everything else was kind of like a relatively muted drop or gain, depending on which one it was. It was really kind of a little bit of nothing all around. Anyway, let's come over to the valuation dashboard. We'll start talking about this. Kind of pointed out, as you said right here, down 2.7% for PayPal today. Everything else is kind of just down about 1% for a lot of the cheaper end of the dashboard, which is up here near the top, and then the lower end of the dashboard looks like it was down a little bit less on average, with very few things in the green. Baytex a little bit in the green, Ulta a little bit in the green. So as you guys can see, here's the new dashboard, fully filled out and fully reformatted. As last week's show, it was kind of halfway in between all the progress. There was still a lot of progress I had to fill out on it, but this is it in its full form. As you can see, added a lot of interesting new stuff to the kind of center area here. As I kind of talked about a little bit last week, I removed the 50-day and 200-day moving averages. Instead, put a composite momentum signal in here that takes into account 20-day, 50-day, and 100-day moving averages. And then it basically says whether or not the stock is trading above or below those ranges, to give you an idea of anywhere from a very bullish to very bearish, and kind of anywhere in between there. Scott, you're asking, the RVol, is it going to be green when it has RVol? Yeah, it should tilt into the green whenever it's over 1, and specifically it tilts towards like a full green whenever it's 2 or higher. So it's basically, it should be about white whenever it's around 1, and then whenever it gets close to 0, it gets to red, and then when it gets close to 2 is when it starts getting greenish. So basically anywhere you know, north of 1.5, it should start to look pretty greenish. It's just, yeah, as you can see right now, no volatility, very little RVol in the in the market this week, really all around. But yeah, that is the way it's formatted. So it should be green whenever it shows relatively high volatility there. No problem. Ask ahead. I'm down. We're just kind of trying to make it through everything a little bit. Lots of things to talk about. I already talked about it a little bit last week anyway. But yeah, also the accumulation and distribution here. Now, I kind of had to pick and choose as to like what kind of time frame I wanted to do this on, because a lot of people like to look at accumulation distribution on like a daily basis and kind of compare it to the daily moves. So what I chose to do is use a 1 month rolling accumulation and distribution. So that's what this is right here. Just keep that in mind. It might go well in terms of kind of comparing it to like an RSI monthly. You can kind of look at the AD accumulation distribution and compare it to the RSI and kind of work between the two. But it is over a 1 month basis, whether or not the stock is accumulating or distributing. And high versus regular distribution or high versus regular accumulation, for the record, is a measure of whether or not it's over its longer term average. I have a long-term average for each individual company that it measures, and then if it's above its average level over a 1 month period, then that's what we define as high level of accumulation or distribution. So basically it's saying, it's like, oh, they're accumulating higher than they typically do, or distributing at a faster rate than they usually do. Then RSI daily, weekly, monthly, you can kind of pay attention to all those. As you can see, it goes between kind of a pinkish and bluish hue. The shorts we had before, the PE ratio we had before, the forward PE ratio we had before, but now I decided to add the analyst target in here. So this includes the average of the analyst targets. Figure that's another way to kind of compare it to. We can kind of compare my value to the target, the analyst target value, as well as pricing. I also have this column here, which these pricing metrics are the pricing that I do. So if I did a comparable analysis on the company, then it includes that pricing number here. So essentially you've got, 3 different numbers to say that the stock should theoretically be worth or should be priced around, that you can kind of compare to all on the dashboard. And then likewise, we have a few different multiples. Obviously we have the regular PE ratio and the forward PE ratio, but then the other column that I added in kind of the value section, which is over here to the right, I added the terminal column here, which includes the weighted average implied terminal multiple that is in the valuation that I did. So basically it gives you kind of an idea of just how conservative I'm being in the valuation, just how much of the value is based off of the operating metrics, or whether it's based off of, mean reversion, so to speak, because a lot of large terminal multiple changes effectively ends up being like a mean reversion play in terms of what you're talking about. So for example, one thing that I would like, for example, call out is like FG. A lot of people ask me like, oh, are you sure about your FG value? It looks like it's like slightly overvalued. Are you going to start trimming this? And I've often poo-pooed that and told people, oh no, I'm going to take my time about it. There's plenty of ways in which I'm being very conservative in that valuation. Well, one way I would point out to that, for example, is look at this. It's a terminal multiple of a 7 on that company is what I'm using on that valuation. So that should give you an idea that this is a relatively conservative valuation, even for me. And we can also even come down here to like the bottom of the page where I have some of the statistics of it. On average, for example, on this column, it's 15.1, median 15.9. So just to give you kind of an idea, it's like, it shows you like 15 to 16 is a pretty typical terminal multiple for me to put on one of my valuations. And so to see a 7 should give you an idea of just how conservative I'm being. And then likewise, well, you could take a look at some of the ones that are over 20, like PayPal, Meta, as well as Amazon, ASML, Netflix. What do those companies all have in common? Well, they all have very strong strategic competitive advantages, or they have very, very strong moats, or they have very, very strong recurring revenue type business models. So you can kind of take a look at how conservative I'm being with some valuations and kind of compare it to which company you're looking at to get an idea whether or not it's appropriate. But likewise, though, as I was kind of just saying with the multiple factors of it, you can compare it with the current forward multiple. So for example, with InMode, the current forward multiple is 8.6, and the terminal multiple I'm putting on that valuation is 15. So therefore, that means that implied within my valuation, there actually is a pretty significant amount of reversion in terms of the actual valuation of the company. It's assuming that in the long run, the market is going to appreciate it, the forward-looking earnings of the company up to at least a doubling level. But then likewise, you could look at another company like, say, Skyworks, where the forward multiple is currently 13, and my terminal multiple is actually lower than that. So that would argue that my evaluation of Skyworks is actually more conservative than even the more short-term forward-looking analysts in the market. So that's going to give you a way to kind of compare how conservative I'm being in my valuations to the current estimates of value done by the analysts within the market itself. So that's basically all the changes to the dashboard. A lot more information kind of going on within it. We did also trim a few companies from the page as well. I don't necessarily remember all of them off the top of my head, but for example, Hibbett and Buckle were both trimmed from the page, as well as a couple others. There was like 4 or 5 companies that we ended up trimming from the page as well. So there's a few companies that we removed from it. And then likewise, we did also change a significant amount about the rest of the pages on the dashboard as well. We had our secondary page where we had a whole bunch of other valuations in here that were ones that I hadn't done a full model for, but were ones that I was kind of like looking to just see how good the value was. Well, I've kind of changed the way I'm going to go about that. Previously, what I had done is I had whenever I had done any basic valuation, I had thrown it on this page here, but instead I decided I'm not going to throw them on this page here unless I think they're reasonably close to fair value, and therefore, you know, after a relatively small significant drop, maybe they could be a good buying opportunity, or if it's a company that I'm really like trying to closely pay attention to for one reason or another. And instead, if a basic valuation I do just doesn't look like it's going to be a good value anytime soon, I'm not going to actually necessarily throw it up on here. So we cleared this entire page out, and then as you can see right here, we did put a handful of companies on here again, another 9 of them. But the 9 that we put on here, a lot of them were a result of the filtering and the screening that we did off of all of the pricing metrics that we had done over the last several weeks. So for example, Canfor was one of the ones that looked particularly good out of the lumber companies I was looking at. BP as well as Valero ended up being some of the oil companies that I thought looked really good in terms of pricing metrics. PACCAR, it was one of the industrials that looked particularly interesting to me. And then there's a couple in here that are kind of random, like Equinox and Silvercorp are both precious metals companies that there are other people that were kind of pointing those in my direction, so I kind of wanted to look at those as well. And then likewise, also Jackson Financial and Spirit Airlines are 2 companies that I own that were on this back page because I didn't build full models for them. One of them being just a pricing investment, the Jackson Financial, as I was talking about earlier, and then Spirit Airlines, which is a merger arbitrage that I'm involved in as well. Hence why it's a terrible value, but it's still on this page right here. But the point is, I decided to include all the same metrics for this back page as the main page, where previously I had some slightly different metrics going on right here. But since I'm going to have a little bit of a thinner page on the back, I figured I can actually have all the same functions on here, because then it's not going to be quite too much of an overload in terms of all of the functions on the spreadsheet itself. But either way, see there's a couple companies right here that look somewhat interesting. Urban Grow is one that we have talked about previously. I can't remember how long ago it was, but it was like several months ago, or I'm pretty sure in one of my live shows I went over this one. It was a company that was recommended by I think Jeff actually was the viewer that recommended this one. I think he said he found it in the index rebalancings for the micro caps. But this is a really interesting tiny company that is a serious money loser for the last several years and probably the next couple of years, but has a really interesting, relatively large market opportunity in front of it. And if it can make itself to terminal profitability, it will actually be a really huge high return potential investment. Something in the range of like 20 to 30% per year over the next decade, but the caveat being that that's under the circumstances where they succeed. There is also, though, however, like a 25% chance that they don't succeed and that they go bankrupt. So it's like 75% chance of really high returns and 25% chance of the stock being actually completely worthless. But on a risk adjusted basis, meaning after you've even adjusted for that bankruptcy risk, I still find it to be worth about $1.82. If I have pricing analysis saying it's worth like $4 to $5, the analyst target says it's like worth $6 to $7. So yeah, it's a really, really interesting company that I like to pay attention to right here. Very, very high risk company, which is why I haven't started an investment in it, but I like to pay attention to it nonetheless. Another one right here that appears to be undervalued is Silvercorp, which is one of the ones that was pointed out to me in this last week. A precious metal company, as the name implies, it's a silver company. Does a little bit of gold and a little bit of zinc and a couple other things, but primarily silver. And it does appear to be significantly undervalued. However, most of its silver operations are in China, and so I think that's probably one of the reasons that it has the value that it has right there. Doesn't mean it's not necessarily a good investment, because most of my aversion to China operators has to do with not believing in the sustainability of the Chinese economy, and then also having a distrust towards the Chinese government system in terms of share structures themselves. So a silver company which sells silver into a global commodities market doesn't have to deal with one of those problems, right? The Chinese consumer and the Chinese economy itself is kind of irrelevant to a Chinese operator of silver. It's going to sell its silver into the global market one way or the other. But there is still the concerns about owning operations in China as well. The company itself, I believe, is actually Canadian, for the record. So it's a Canadian company that operates largely in China, as well as some other places for some of the other stuff it does, but a large percentage of its operations are in China. So I'll be taking a look at that one. I'll be considering some things related to that one because of the value that it appears that maybe has available to it. But yeah, two possibly very undervalued companies I haven't jumped at because they have risks for one reason or another. Canfor is, as a lumber operator, appears to potentially be fairly valued. Jackson appears to be fairly valued. That's why I started trimming it. BP appears to be around fairly valued. I've been looking for a potentially undervalued oil operator. So that one potentially could be a good company to hop into if oil was to go a little bit lower and present an opportunity. Packer appears to be a little bit overvalued, but not majorly so. So we decided to put it on here just in case we wanted to pay attention to it if it decided to head lower. Likewise with Equinox, a little bit overvalued, nothing too major. Valero, a little bit more overvalued than BP, but nothing super major. We can pay attention to it. And then I already talked about Spirit Airlines. This is a merger arbitrage opportunity. The only reason I'd be paying attention to it because it's a huge bankruptcy risk itself. So that is what it is. So those are the companies that we have on the back page currently. We might be taking a look a little bit closer at some of those. But as I was kind of talking about last week, part of the reason I've been able to make so much progress looking through so many companies this week, and I did most of this work over the course of just like 2 days and really only half-heartedly for both those 2 days. So I got through a lot of this work pretty quickly. And that was kind of the point I was trying to make last week, is that a lot of the changes I did to my DCF template as well as my dashboard spreadsheets were basically to try to streamline my workflow, make it so that I can really get through a lot more companies a lot quicker, especially the more arduous, time-consuming parts of just processing the data and getting the financials in order to get it to a position where I can actually start to analyze the company. There's a lot of like kind of groundwork I have to do to get the financials in a position where I feel like I can actually do really good analysis and put a good valuation together. When really you want to be doing that analysis. That's what you want to be spending your time on. So the point is all the things that I was working on for the last couple weeks to kind of do those things seem to have been very successful. This week was a lot easier to plow through several new valuations that I had never looked at before, which is good because it means I can find some interesting opportunities, and then I can start to actually look at the business models. That's the thing, is like I can find companies that are underpriced, which means they'll appear to be cheap relative to their peer groups, and then amongst the underpriced companies, we keep looking until we find something that appears to be undervalued, and then once we find something that is both underpriced and undervalued, and ideally in an industry that we were somewhat interested in to begin with, then we can start to actually look at the company specifically and really build up a more sophisticated model of the company itself. So that's kind of like the game plan, the strategy we're trying to take in our company finding process going forward. And so with that, obviously, I was saying before that there was a lot of companies I had put together that I wanted to look through, and I have looked through a handful of them, as you can see right here. And if I was to come over to, for example, my folder over here, there's a handful of companies that you can see have folders, which means I did start putting them together, basic valuations for them, but they're not on that back page of the dashboard, which means that in the end, they weren't good enough. So as you can see, that means that there's actually a pretty significant amount of progress that I made this week if we were to kind of add all of the the newer additions on the dashboard, plus all of the ones that have a folder but didn't make it onto the dashboard themselves. But that ends up being like 15 companies or something like that, just right there. Dan the Gentleman, hello. How's it going, man? How's it going? I've enjoyed some of your comments and your chats in the Discord as well. But yeah, so the point is though, I do have kind of a direction that I'm going to be taking in terms of trying to continue this process of looking through lots of companies. First off, I do have a handful of other companies I want to look at, both ones that were a part of those peer group screenings that we had done over the last couple of weeks, as well as a couple of companies that are just hangover suggestions from some viewers, as well as a couple of companies that were suggesting me for one reason or another, or ones that were even on our back page previously that I kind of wanted to make sure and double check on them again. So we do have a kind of short list of a bunch of companies I kind of wanted to do a quick through evaluation on and see if they are reasonably close, and maybe go onto our potential page and then maybe even get a full model and end up on our main page later on down the road, but we'll have to see about that. So yeah, a handful of companies right here. We'll maybe be trying to do at least half of them, if not, majority of them over the course of the next week. But then also there's kind of an approach I was looking to take going forward into trying to look for some other companies a little bit by sector or even by industry. Dan the Gentleman, did you ever look at GSM stock, Ferroglobe? I don't think I've ever looked at that one. I'm assuming by the name it's an iron company or something like that. It definitely sounds like Ferroglobe. Operates in the silicon and specialty metals industry in the United States, Europe, and internationally. Provides silicone chemicals that are used in a range of applications, including personal care items, construction-related products, healthcare products, and electronics, as well as silicon metal for primary and secondary aluminum producers. Interesting. Some of that does sound kind of appealing, although some of it sounds a little questionable in some other ends too. I'm not sure. I'm not sure if you had suggested this one on another video or something like that. It kind of sounded like you expected me to have heard of it, or I'm not sure. Let's see what they have on estimates. Looks like a little bit of a decline expected next year, and then a pop back into growth the year after that. Pretty decent growth looks like too. Kind of mid-teens margins is what's expected in the short term. How does that compare to kind of their silicon mining? I have an easy time analyzing it. Yeah, well, see, I kind of like some of the product categories it sounds like they're in, personal care products, as well as some of those industrial products, like an interesting kind of spread of products that are, or industries that they're selling to, which I kind of like the idea of. That does sound kind of appealing, but it is, I'm not sure I would be a big fan of this particular commodity in terms of a commoditized space, because silicon isn't exactly a super scarce material. So I'm kind of curious, like, where some of their competitive advantages are. They might have some strong competitive advantages in terms of like how they put the materials together, but I don't really know too much about it. These margins definitely look a little bit volatile and on the weak side, and some of the years prior to 2020 it looks like definitely as well. So definitely something to kind of keep in mind. But yeah, I don't know, maybe kind of keep that one in mind. I'm not necessarily sure how interested I am in the silicon space in general, though. I like a lot of commodity spaces, but I got to have like some sort of specific theme or thesis as to why I'm expecting that commodity to do well in the future. And I kind of would, my initial intuition is to believe kind of the opposite for silicon, but I could be totally wrong. On that. Anyway, so in this list here, ones that I believe were definitely part of the peer group comparables that we had put together over the last couple of weeks. I'm pretty sure P-Lab was in there, AngioDynamics, Chart Industries, Intuitive Surgical, American Outdoors, West Fraser, and then the rest of them I think were also some of these financials as well. These ones were all in the comp groups for FG as well as Jackson. But yeah, so like all the ones that are highlighted right there are ones that I expect to maybe have some potential good value just due to the fact that they were underpriced, whereas the other ones were ones that were recommended by other people and or were ones that we kind of were already paying attention to a little bit previously. So we'll kind of see where things go with that one. Now, one of the comparable groups that we had compared with a little bit
over the last couple of weeks, I had shown a large cap comp group where I had essentially just taken the 30 largest market cap in the United States and put them into a comparable group to kind of compare together, which on one hand, that kind of works because of the fact that they're all large cap. It means there's a certain amount of comparability in terms of the way the market will treat them, just because of the fund flows and how they move together all in large caps. But on the other hand, they're also all in very, very different industries. So it didn't really put together a circumstance where you can really compare these companies on a super easy basis, since like some of them are technology companies, other ones are drug companies, other ones are manufacturing companies, and other ones are finance companies. And a lot of like the financial companies, for example, are pretty like obviously the cheaper ones when you're doing a comparable analysis on that basis. So while I kind of like the idea of grouping them together by market cap, I still kind of wanted to keep them separated by industry. So one of the ideas I had in terms of thinking about this for going forward was, I was like, okay, well, why don't we take a look at some of the sector ETFs and the performance that they've had over the last different time periods, 1 month, 3 month, year or so. And then we'll take a look at, well, you can kind of look at it from both perspectives. You could look at, say, over the last 1 month or something like that, whichever ETFs have done the best over the last 1 month. Maybe there's some short-term momentum reasons. Even in the momentum could be based off of fundamentals, for the record, but it could be some fundamental reasons to believe that momentum should continue. So maybe if we look at the ones that have done really well in the last month or so, and then we did a comparable analysis of, say, the top 30 or 50 companies in that index, then maybe we could find some companies that are underpriced on that group, and then we can find companies that are undervalued amongst the ones that are underpriced. But then, like I said, that's more of a forward positive momentum way to look at it. You could also look on a 3-month basis or even a 1-year basis, and say, okay, well, which sector ETFs have actually done the worst relative to the market. For example, we've got XLE, the energy ETF, as well as let's see, what's the next worst one. I mean, honestly, it's in a year where basically all the sector ETFs did positive, except for, it looks like, utilities and energy, which is pretty interesting to see. Or no, there's one more in there that didn't do negative. Or XLV is flat on the year. Which one's XLV? Oh, healthcare. Okay, I always get them a little bit mixed up. But either way, the point is we could look amongst the utilities and the energy and the healthcare ETFs, since those ones are the ones that were the biggest laggards over the last year. And then for each one individually, take the top 30 or 50 stocks in that ETF, and then do a comparable analysis similar to what we've been doing for these companies right here. Which is something I'm planning to do over probably the next several weeks or months or something like that. This is going to be kind of like how I'm going to be looking to search for new opportunities. We're essentially going to be trying to go sector by sector, so that when we do the comparable analysis, the actual the fundamental metrics actually work well with the pricing metrics, and the statistics should work well because they're all within the same industry. But then as of course of choosing the industries, we'll be kind of looking at which ones are the biggest laggards in kind of the more midterm, or in the very, very short term, which ones are maybe actually outperforming. Like I said, you can kind of use a positive momentum to it as well. So that's kind of like my ideas for how I'm going to be searching for other companies going forward over the next several weeks. And like I said, I'll kind of be pairing that up by doing the pricing analyses, and then we'll be doing the valuation analyses, and then all together, like I said, that's also going to be following after I finish clearing out some of these. So, I mean, that's pretty much all the stuff I wanted to talk about in terms of the valuation dashboard stuff that I've been working on, all the changes I've been doing. Like I said, we cleared a couple companies from the main page, and then we cleared out the secondary page entirely, and then already started to fill it in a little bit differently. Beyond that, pretty much just getting ready for my next semester of school to start after the first week of next year, which will be pretty exciting. That's actually going to be my final semester, finishing my bachelor's degree, so that'll be pretty good. Pretty excited to get back to the workforce after that. So if you guys want to maybe take a look at some companies, obviously Dan there already started suggesting one, but we can start to take a look at some other ones as well. Pretty much talked about all the things I wanted to talk about here today. Oh, yep, Dan, what do you gotta say? Something interesting to tell me? Oh, one other thing I kind of wanted to comment on is I also have this back page here where I have all of my commodity price forecast that I did relatively near the start of the year. All of this information was based off of end of year averages from 2022, and we're projecting essentially 1 year averages for the commodities 10 years forward. So we're trying to project prices 10 years forward, but really we're trying to project more of like a range of a price, an average of a price, so to speak. But the reason why I bring that up is because here at the end of 2023, that obviously means that all of these fundamental and macro data points that I use to put these price forecasts together will all have one more data point to them. So I'll be able to actually update these forecasts and make new 10-year forward forecasts and then compare that to it. Now, then also at the end of when I was doing those comparable analysis, what I did is I took a weighted average of the expected COGRs for the commodities and then weighted them by the weightings of the commodity index to get an idea of what a commodity weighted price change would likely be over the next decade. At the end of 2022, it was a negative 1.2% expected over the next decade. So it was expected to have commodity deflation of about 1% per year over the next decade. Now, if I use updated commodity prices with the 2022 end of year forecast with the most recent commodity prices, and then take a look at what it would be expected, it would now be an expected commodity COGR of 3.3%. So it just shows that commodities have come that far down over the last year that it went from an expected 10-year forward negative 1% per year to now being a positive 3% per year. So a very, very significant decrease in commodity prices over the last year, which means that, in my opinion, it's much more likely that we're going to have upward movements in commodity prices over the next 10 years. I mean, this is a 10-year projection, but it wouldn't shock me if we saw significant movements over the course of the next year, which is why I'm bringing it up here today at the end of the year. Dan the Gentleman, what you were saying, it is a divided in sector as well. Very organized. I do my company searching there. I'm sorry, what was it? I'm a little confused. I'm not sure if I missed. Oh, okay. I think I missed one of your messages. Thanks. I don't have GSM in my portfolio. Was just analyzing the basic material sector, and I stumbled with this one. I'm also considering taking a look at it. Anglo Gold Ashanti. Oh yeah, I've heard of that one. I don't think I've looked at it super closely, but I do like to look at a lot of gold companies. AU, is that what that one is? And I am looking to look at some other gold companies. As I kind of had mentioned there in the process, one of the ones that ended up being looked at and was put on the secondary page here is Equinox Gold, which I found to be a little bit overvalued, but either way, I figured I would kind of pay attention to it in case there was going to be a little bit of a dip in the short run. And I do already have Barrick Gold within my portfolio, but definitely trying to look for other opportunities within the gold space. I had also looked at one other one this week, I-80 Gold, which I found to be significantly overvalued, as well as Franco-Nevada, which I found to be significantly overvalued. So in this last week, I've been definitely looking at the gold space and basic materials in general. As I had also shown, there was a Silver Corp, which ended up on this page as well, which does appear to be overvalued, but does have significant risks associated with it, given that it's a Chinese operator. So you know, a little bit of a mix of a thing there. But I am very, very interested in the basic material space, which as a sector is definitely not one that lends very well to doing the type of analysis I was talking about in terms of the sector ETFs, because with basic materials, well, each basic material is kind of like its own you know, dragon, so to speak. They all have their own little quirks and funny attitudes to them. You know, oil and gold have some similarities, but they have more differences than they have similarities at the end of the day. So yeah, interesting company. Going back over to it, I did pull it up over here. I can't really remember too much about them. I'm not sure if I've ever actually looked super closely at them. So let me get my bearings on them real quick. Dividend yield 2.5%. Operates gold mining company in Africa, the Americas, and Australia. You know, we like the Americas, we like Australia, or well, we like some parts of the Americas, and we like Australia. Africa, not so much, but that is where the gold is sometimes. In the Americas, it kind of depends. Yeah. Let's see. Its flagship property is a 100% owned Gedi project located in Lake Victoria Goldfields in the Mwanza region of Tanzania. Okay, yeah. So their biggest holding is in Africa, which Tanzania is, well, I mean, there's worse places to operate in terms of companies. Obuasi project located in Ghana, AGA Mineracao in Brazil, Saragande located in central Brazil, Greenfield projects in Beatty District, Nevada, and Sunrise Dam in Australia. So okay, yeah, they're decent spread of projects across Africa and Central America as well as Nevada. So interesting. Oh, are they actually headquartered in South Africa? Yeah, I didn't actually even get to that part of the thing there. South Africa. Interesting. So let's see what are they expecting over the next few years? Looks like they have pretty steady growth expectations and revenue. I'm curious of how much of that is price implied or if that's volume implied. Let's see, EBIT margins look like they're in the mid-teens, at least currently on the expectations. We'll see how that compares to the historics. And then free cash flows are looking to grow pretty significantly over the next year or two, or well, it's really more of a rebound from the peak levels in 2022. Okay, so definitely, you wouldn't really expect very strong gross margins for a miner. So that's not, I can't really complain necessarily about the low gross margins. It's kind of what you would expect for this industry. The EBIT margins are pretty strong, all considered. It looks like they're not losing too much drag overall to, general expenses. As you can see right here, they're very, very closely following the gross margin, the EBIT margin. So there's not a whole bunch of like excess crap expenses going on there. Relatively low asset turnover, which is kind of what you would expect for a mining company as well. But pretty stable. Doesn't look like there's anything too crazy going on there. Let's see, how's their liabilities? Liabilities were kind of middling, but looks like they've been improving. So it's good. It's good. It's what we like to see. What's the stock been? We only have 1 year. What's going on with that? There we go. Okay, yeah, so it looks like the market has been appreciating the balance sheet cleanup a little bit. It looks like. Going back to the full 10 years. This is when they would have had the higher levels of liabilities. And so I see upward movement, as you can see, which obviously is going to have to do with the gold price as well. But at the same time, they could stay at the same range. Look at, for example, the gold mining ETF compared to the gold price itself. You'll see there's like a huge lagging there. It doesn't necessarily have to be a close follow. So yeah, I mean, it looks like AngloGold Ashanti is pretty interesting. Let's see how the valuation is now that we've kind of looked at the operating metrics. Let's see how cheap they actually are. Well, I wouldn't really call them very cheap either, though. I mean, they're obviously not very expensive, but I wouldn't call this necessarily a screaming buy either. So that's one thing I would say. It's like they operate in a lot of risky areas, so you really would want to get them super cheap. Like to be honest, like if they're primarily operating out of Africa and Central America, then I probably would want maybe in those single digits in terms of wine valuation. Like they might be fairly valued right now, but fairly valued isn't really a good opportunity, right? So that's kind of what I mean. It's like this is kind of like the multiple that I would expect them to trade at if they were about fairly valued and they had kind of normal operating metrics at. So they don't look like they're necessarily super cheap. And they don't necessarily have, like I said, some of the more preferable operating regions to have. I mean, gold, there basically never is the best of operating areas. It's just kind of a crapshoot in terms of gold. But at the same time, it's like, yeah, I don't know. Definitely, I'm not sure it stands out to me necessarily as a super amazing opportunity. But I do think that there probably is some really good opportunities to find in the gold space. As I was kind of just already saying, I've been looking, and obviously I haven't been able to find anything super amazing. What with, as I kind of already said, one that's overvalued here. The one that's in my portfolio, I've got at about fair value here. And then I did a couple other ones here in my folders that ended up being overvalued as well. So I've been looking at the precious metal space, and as of partially off of the backs of what I was kind of just hinting at. If we can kind of compare the gold price and how that's been performing compared to the gold mining ETF. Let's pull that up, for example. And there's just been like a huge disconnect between the prices of them. Oh, hold on a second. Like over the last decade, the gold prices come up pretty significantly, but the gold mining ETF is actually down. So there's pretty significant amount of gains to be had theoretically from that. Of course, this isn't necessarily something that you do have to take into account dilution factors whenever you're talking about like an ETF's value over the course of a decade. So dilution factors as well as dividends have to be taken into account with this. But in general, the gold miners have significantly underperformed the gold metal itself. So most people are expecting some huge revisions for whichever companies are essentially bearing all of that excess return. Dan, you say you don't have any companies within the gold sector yet? Yeah, well, I mean, like I said, hard to find one that I think is actually a screaming buy right now. Barrick is fairly valued. That's the one that I have in my portfolio, and I would say that it's about fairly valued right now, which therefore isn't really a great recommendation for you. And then, like I said, I'm kind of paying attention to Equinox, but I think it's about 10% overvalued right now as is. So I mean, those are my thoughts on that one. Do you guys have another company you want to take a look at? Anybody else have any good recommendations to look at? Company that you do have in your portfolio is Cal-Maine Foods. Cal-Maine Foods, we were looking at that one not too long ago. I feel like somebody had recommended, oh, Calm, that's what it was. Okay. Oh, that's right. This one has all the eggs and the butter and the other stuff. Land O'Lakes. Trying to remember what my thoughts were kind of on this one. Several years of expectations ahead of us. It looks like next year they're expecting a huge decrease in revenue off of the back of the huge increase from this year, probably from the egg price readjustments is what I'm going to assume that's coming down from. And then they had huge margins in 2023 from likewise, but they're expected to drop back down into the single digits. Pretty interesting on that front. So you're saying you have this one in your portfolio, Dan? Interesting. I hope you didn't buy at a overly exuberant point. I don't know what the stock price has been like. I haven't looked at that part yet. But hopefully you were able to get it at a good value point. Let's see, compare the gross margins with the EBIT margins. Likewise, relatively low gross margins, but the EBIT margins do follow them pretty closely, which is nice. See, I was kind of expecting there to be more of these like low single digit EBIT margins. There's actually some more teen high level margins here in the past as well. So not just the most recent couple of years, but there are these significantly negative years and then a handful of just kind of like moderately negative years as well. So these margins are definitely not very pretty, that's for sure. Let's see, compare that with maybe the liabilities. Okay, so they do keep the liabilities low. That's good. They keep the liabilities low, not super low, but low, which is good. They understand that they have a lot of risk, it sounds like. Asset turnover is pretty strong, which is good. That's what we would sort of like to see. Dan, I really like Cal-Maine Foods. They have 20% of the US market share in eggs, and I see some competitive advantages in it, especially biosecurity advantages in avian flu crisis moments. I mean, how did they have what do you mean by them getting a biosecurity advantage in an avian flu crisis moment? Because wouldn't that have a pretty negative effect on their bottom line? Or are you just assuming because of like prices going through the roof that would bolster it? Or do you mean like on a personal level, this kind of like hedges your own your own consumption of eggs. What do you mean exactly by that? Also, larger scale, he says, about the prices, it's a commodity. They can't really control egg prices. Yeah, of course. Yeah, don't worry. I understand commodities just fine. I'm a big commodity guy, so I understand how commodity companies work. It's like they can't control prices. They can only control their production and their efficiencies. And then at the end of the day, it comes down to the market to decide that. Yeah, I understand commodity prices and all that. I'm just curious to see what about it you think gives you a biosecurity advantage in food crisis moments? Because I would assume that there could be kind of positive and negatives on either end of it for that. Now, Scott, get into your question. I did see that you would ask a question. Question about the dashboard. If AD is one way but momentum different, then you could say divergence. Yeah. In general, I would say so. What I would say is, like, keep in mind, like I said, the slightly differences in the way that what's being calculated there. So it's like for the AD, like I had said before, it's like if it's over the last month, it's a 1 month time frame. If over the last month they've been accumulating, it'll be this like pale shade of yellow for the accumulation letter. And then if over the last month they've been accumulating more than they have on average over the last 10 years, then it'll say high accumulation. And then likewise, if it's negative, it's distribution. If it's negative more than on average over the last 10 years, it'll be high distribution. But then with the momentum, like I said, there's the 20-day, 50-day, and 200-day moving averages and the price. And basically, if the 50 days over the 200-day, the 20 days over the 50-day, and the price is over the 20-day, those are all momentum signals. And so, like, very bullish means that all of those are over each other, and then very bearish would say all of those are under each other. So if you have a positive, a bullish momentum, and then you have like a distribution to it, then yeah, that would be a divergence, but you kind of have to keep in mind like the time scale differences between them, because the momentum signal takes into account 20-day, 50-day, and 200-day movements all in this one column here, whereas the AD column only takes into account a 1 month time frame, if that makes sense. So it's like, yeah, you could use the two to kind of say that there's a divergence there. Like, for example, PayPal is distributing over the last month, but it does have a low bullish signal. So there's a little bit of a divergence going on right there. We have a little bit of a similar divergence going on with AAP right here. You could say there's the opposite is going on with Baytex right here. Like there's a mid bearish momentum, but it's been accumulating a lot over the last month. Right. So it looks like those Baytex shareholders, maybe they know something, right? I don't know, or something like that. So that would be kind of the way you could look at this and kind of combine the two together. And then, like I was saying before, since the AD column is over a 1 month time frame, you could compare that with the 1 month RSI as well, right? Because those would actually be the same time frame. They're both over 1 month. So that's all I would say is, like, keep in mind that they don't have necessarily the same time frames if you're gonna compare the two between there. Coming back over to Cal-Maine and Dan. Last time avian flu crisis happened, they reported 0 deaths on that, and the competitors' chickens died a lot. About 10% of all chickens in America died the last avian flu crisis. Okay, so you're saying that they have good biosecurity. That's what you're saying. Okay, gotcha. Interesting. I'll have to look into that. I do remember yeah, that what you were talking about there, that last avian flu crisis where they had that huge percentage of all the birds die. Definitely makes a huge difference. But yeah, I'd be curious to look into what it is exactly that Cal-Maine did that made a big difference for them. But yeah, I mean, could be an interesting company to look at. I feel like it might be a little bit late to the party to be looking at egg companies. Obviously, egg prices have already come back down and everything, but I wonder whether or not the valuation is in the greatest spot. So yeah, it looks like another one that doesn't look expensive, but it doesn't look cheap either. But it's also hard to say. Yeah, see, like, looks a little bit pricey in the most recent time frame, but over the last year it was relatively cheap. This is kind of like an in between there. And obviously over the last years when we had higher egg prices, so you can see like they had a very, very low multiple during that kind of time frame when everyone was expecting the earnings to drop through the floor, right? It's like everyone was probably expecting their earnings to get cut in half, so that's why it was trading at like a 3 to 4 or whatever. But now it's trading at an 18, 15, and that kind of range right there. And then the forward estimates are, more of a muted level. So it's one of these things where it's like it's kind of interesting. Huge revenue declines are expected next year, and then looks like the EBIT's also expected to crater as well. So interesting. But yeah, I don't know. I'm definitely not thinking that they look super amazing for me to look at right now. Like I said, it's like interesting commodity space, and I do like the food space in general, and I kind of like the idea of eggs in particular, especially if they have some good competitive advantages. But I feel like this isn't necessarily the right part of the cycle for me to be looking at them necessarily. But yeah, interesting. All right, so any other companies you guys want to take a look at? Maybe take a look at one, maybe two more before we call it for today. Back over to the dashboard. I know, Scott, you commented on Hershey. I guess I could maybe make some comments on that. I did have Hershey on the list over here. Yeah, well, maybe we'll look at Hershey. Take a look at some Hershey. Saw you were pretty quick to throw this one in your portfolio. Yeah, very generous of you, Dan. You sure are the gentleman, as you say. I will take this moment. Anybody who's watching live or on the replay, if you haven't already, please like the stream. Please subscribe to the channel if you haven't already. Hit that notification bell and all that. Also, consider joining the free Discord. Link is in the description below. Also, a pinned comment in the chat. Join our Discord where we have discussions of what's going on in our portfolio, daily actions of what's happening in the market, actions of major investors, and stuff like that. So come be part of the discussions there. But yeah, so let's see, Hershey here. Also some relatively low growth expectations, but at least they don't have a huge cratering to deal with first, unlike Cal-Maine. Mid 20s EBIT margins for a candy company. Pretty interesting. And also very, very stable in terms of the expectations line. We'll have to see how the historics actually compare with that. Free cash flow margins also in the teens. Pretty nice to see that as well, with EPS growth expected over the next couple of years. Go back over to their financials. Take the full 10 years. Gross margins a little bit up and down a little bit, but it stays kind of all within this mid 40s range. So it looks a little bit more volatile than it actually is, but it's only from 43 to 46. So it looks volatile, but not really. It's actually very, very low volatility all considered. Very, very mid kind of gross margins for a confectionery, kind of like discretionary products type company. That's pretty typical. It's nothing super extreme in that front. Comparing those EBIT margins that we kind of talked about, a little bit more of a wiggle room there as we might expect from a products company. Not quite the same as the food companies that we were just talking about, where they're so closely aligned here. There's some real selling, general administrative, and marketing expenses probably as well that goes into this. But either way, still mid 20s, as we were saying, from high teens into the low 20s. It's been drifting upward, this EBIT margin over time. So that's pretty interesting to see. Dan asks, do I already have companies in the oil gas sector? I do not currently have any exposure in oil and gas. I do have a couple of those companies that I've been paying attention to that are on my dashboard, but I never ended up pulling the trigger on any of them. Baytex right here, which is about fairly valued. I had it as slightly undervalued when I first did my video on them. But then they became very overvalued very quickly, and then they've come back down. But they're not undervalued yet either, so I haven't ever pulled the trigger on them. Then there was Parex Resources, which my attitude about them has kind of moved up and down a little bit. And when I was actually changing the templates around, that did actually change a couple of the values for some of my companies depending on a few different factors. So this one was one that I thought was undervalued not too long ago, but due to some changes in the estimates, I now find them to be actually significantly overvalued. And then, as I was saying on this back page here, I recently did a basic valuation of BP. I found it to be about fairly valued, and then Valero, which I found to be significantly overvalued. So I've been looking through the oil and gas sector, but I haven't really found one that I think is like truly undervalued and a good opportunity to it. And then I was talking about several weeks ago, and this is kind of just something I think goes well in line when trying to think about commodities as well, is that you have to think not just about whether or not the company is undervalued, but you have to think about the commodity itself. As you were just talking about, you don't control the commodity price when you invest in a commodity company. So you have to kind of think about the commodity itself. And I do have my own perspectives on where commodity prices are going. It's easier to talk about gold companies because I think gold's going up. Right. I think gold over the next 10 years is likely to go up pretty significantly. Like I have a 10-year forward predicted price right here of a little under 3,200 an ounce. That's again 10 years from now. So that means I expect gold to go up about 4% per year, 4.5% per year. At the end of last year, it was closer to 6% per year. Oil, it's not quite the same situation. That's kind of why I bring that up. Oil at the end of 2022 was about $95 a barrel, and I was expecting actually negative 2% per year for the next 10 years, because I was expecting about a $76 price 10 years from now. Now oil is back down to about $71 per barrel, but that means I'm expecting about 0.5% per year for the next decade. And now, as I said at the start of the stream, I'll probably be updating all the data and updating all these estimates over the course of the next couple months. And so these estimates might change. Small amounts, might change to large amounts. I don't know. It kind of depends. We'll see on that front. But the point is I was talking about this several weeks ago when oil was at like $68 or $69 a barrel. I was saying, hey, actually, I think oil's finally about fairly priced now. And the reason why I said it was fairly priced is because it was me taking this prediction price of $76 per barrel in 2032 and then discounting it back at about 2% per year, which is like a, inflation rate or something like that. And then that told me that 67 to $68 a barrel would have been an appropriate oil price. And so when oil was back down there, I was saying, hey, oil is about fairly priced. Now, if you could find a company, an oil company that's undervalued, you would have fairly priced oil and an undervalued company, which means you kind of have both those things work in your favor. So a long way of saying that I want oil exposure, but I want oil to be at least fairly priced or underpriced if I'm going to take on exposure to that commodity. Gold, I have gold exposure right now. I think gold is underpriced. I have lumber exposure right now, and I think lumber is significantly underpriced. Right. So you can kind of see like where my mindset is on that. And so likewise, you can see like what other commodities I would like exposure to as well. Silver is underpriced. I do have some silver exposure. It's just not in my stock portfolio. I have some physical silver metal. But the point is I've been interested in copper companies. That would explain why I'm interested in copper. Iron, I show to be a pretty significant opportunity as well, but I haven't ever found a good opportunity in iron. And then beef, there's good opportunities in beef as well, which I did have exposure to beef through Tyson through most of this year, but I did recently cut the exposure to that after deciding that Tyson wasn't a good value as well. So I am looking for oil, but I need oil to come back down into those mid 60s before I pull the trigger on anything. If BP is still about fairly valued, and we get oil to be actually underpriced, well, then maybe I would even pull the trigger under those circumstances. Because then at that point, I would still say that I have at least a couple things working in my favor, if that makes sense. You want the commodity price to work in your favor. You want the comparable group to be working in your favor. And then you also want the valuation to be working in your favor. Kind of like a little bit of all together. Yeah, so you're talking about Chesapeake Energy. Yeah, Chesapeake Energy is natural gas, which is not exactly the same. And then I didn't necessarily mention it while I was talking in that space right there, but I do have natural gas projection on here as well, which natural gas, I was expecting significant deflation at the end of last year, but now I'm expecting significant inflation from how far natural gas has come down. So I would say that natural gas is a pretty good space to be in as well, due to some of the same reasons. I would say natural gas is better to be in than petroleum right now, oil. I would say natural gas has better pricing in general. And it's worth noting that that is primarily what Baytex does as well, is primarily natural gas. So I was kind of talking about them all together because I kind of think about them all together. But they're, yeah, obviously not the same. So is what it is. So let's take a little bit of last look at Hershey's. I kind of got distracted there talking about the commodities and stuff like that, but I'll still comment on the valuation. Another company that, you know, doesn't look super expensive, but it doesn't look super cheap either. It looks, it's come down from being expensive. So that's one thing where it's like, if you're looking at Hershey's historic PE ratio, you might look at this on average, their PE ratio has been 22, 23 for the last decade. And so if you're looking at that and you're seeing an 18, 19 right now, that's going to look like a steal. But I would also point out that the EV to EBIT has been 17 on average, and it's currently 15, 16. So EV to EBIT isn't as good, which means that, for example, way back here, there was some significant interest, tax, and debt cost differences that were accounting for the difference between these two multiples. And you can see that narrowed a little bit over the course of the last 5 years or something like that. So yeah, it's like Hershey's has come down a lot, which is why I see a lot of people talking about it. And a lot of people expect that it will come back up to these higher multiple levels, partially because it's such a premium brand. Hershey's chocolate, right? You know, such a premium brand gets a premium multiple. And it's like, well, I don't know. I don't think the business model itself is necessarily such a premium. So it's one of those things where it's like, it's just a food product, you know, a food product that people love and definitely has a brand name associated with it. But I'm not so sure that I would necessarily want to pay for that premium either. So yeah, I don't know. It doesn't look super expensive, but it doesn't look super cheap to me either. I would personally rather get this one maybe at like an EV to EBIT of around a 12 or a PE ratio of around a 15 or something like that. A little bit lower, I would think. I think if I was to do a valuation of Hershey's, I feel like I would find it to maybe be about fairly valued. Like this is around where maybe I would say it would be fairly valued, maybe even still slightly overvalued, but definitely still interesting. So yeah, I don't know. That might be it for today. Appreciate a couple of you guys coming out and chatting for a little bit. Like I said, it was nice to chat here at the end of 2023. I didn't comment necessarily too much on returns at the start of it. I partially don't necessarily want to talk about it too much, but you know, I might end the year with about 17% for me, which is, you know, a little bit disappointing compared to the S&P 500 getting like 26.5% over the course of the full year. So a little bit disappointing in terms of comparing our returns to the S&P 500. I blame that largely on being way too over allocated to cash throughout the vast majority of the year, and also having stuck with some real losers for way too long over the course of the year as well. And so probably should have ditched some companies a little bit faster, held on to some other ones. There's some trimmings that I did earlier on. Like for example, I trimmed a significant portion of my Meta early on in the year after it had already been running through the course of last year. But Meta was one of my best performers this year. Obviously, it's still my portfolio. I didn't kick it all the way out of my portfolio, but Meta was one of the best performing stocks in my portfolio, and I was trimming it early on. So, you know, big mistake there in terms of trying to hold on to all those excess gains. One of my other bigger gainers this year, FG, people were asking me when I was going to trim that one all year. So on the other end of the scale, FG is one that I absolutely refused to trim all year, and good on me for doing so, considering it is a better performer than Meta, actually. So FG, big winner. That's obviously our big winner of the year. We're super proud of that one, and I know it blows people's mind when I tell them that I think that it could easily, well, not easily, but it could definitely double from where it currently is over the next couple of years still, in my opinion. And then coming back over to, for example, what I was talking about on the dashboard, it's like on the main page of the dashboard, FG is the company that I have the lowest terminal multiple on. You can see that right here. So out of all of the terminal multiples that I've applied to all of my full modeled valuations here, FG is the one that I'm being the most conservative on in terms of how the market will price it in the future. That's basically, you know, that's what the terminal multiple is. Now, I'm probably being very bullish in terms of the operating metrics, like the revenue growth and the margins and stuff like that. Or, you know, I don't think I'm being super bullish. I think I'm still being pretty reasonable. But the point is I'm being more bullish there than I am with the terminal multiple. So it's very interesting. I just want to point that out because, like, you know, you could easily have pushed that terminal multiple up to a 10, and then that would push the fair value 30% higher, right? Just like that. just like that, easily, and it wouldn't even be an unreasonable thing to do to the valuation. So just kind of pointing that out. It's like I said, my biggest gainer this year, I think could continue to be a big gainer in years to come. FNF is one that was a big gainer in years past, and we had lost basically all those gains, and then those gains basically came back. Like I said, Meta was one of the better gainers throughout the year, but honestly, we cut it a little bit earlier than we probably should have. Jackson was a great performer all throughout the year. And then we had several other companies, like I said, that kind of floundered, went up and down, kind of zigzagged throughout the year, were big wastes of time. Some companies that I'm super happy that I'm in, but maybe I should have waited a little bit longer to get into. I'm very, very happy with some of the positions we started this year. I am, like, obviously I've been talking about FG. I'm super proud of the analysis I did on FG and all the due diligence I did on that one, because I do think that that's going to be a multi-bagger over the course of the next several years. But I'm proud of the analysis I did on Generac and PayPal and InMode. I'm really, really proud of all the work I did on those ones. I do think those ones are all going to be, big gainers in years to come. We're already up pretty significantly on Generac, but the other ones I think will be big gainers in years to come as well. And then, like I said, there's other mistakes I made as well. I'm happy with the analysis I did for AAP, but I definitely got way into that one way too early. So that one's one that's kind of floundered a little bit when we probably could have been doing a little bit better than we otherwise could have under those circumstances. So either way, hopefully we'll have better cash management next year, and hopefully we will continue the trend of better analysis on better longer term opportunities. And also we will continue the trend of better allocating more of our capital to those longer term opportunities and keeping smaller amounts of capital for allocating to our shorter term valuation plays or more shorter term catalyst based technical type investments, and really focusing in on longer term growth opportunities in the future. Dan, some of those last comments you had right there. Dan's biggest winner this year was actually the Brazilian portfolio. It was something like 26% return this year. My US portfolio had less gains. Very good year overall. Yeah, it was a very good year overall. Obviously, as I had commented on when I was looking at those sector ETFs, it's pretty interesting to see that even if you break it down by the sectors, the vast majority of all the sectors were up. It's like we only have the utilities and energy and what's that one? And consumer staples that are down. And then two of those three were down only like 3%, whereas utilities is down like 10%. So utilities is the only sector that has like a real significant downer year. And then we have, three different sectors that performed over double digits, like more than 20%, more than 10%, they over 40%. We have XLY, XLC, and XLK. So what is that? That's communication, consumer discretionary, and tech. Yeah, so those three all performed over 40% this year. That's pretty insane, pretty insane. But yeah, so it's like it was a really good year, but as that kind of shows, a lot of that great returns were concentrated in just a very few names. So it'll be very interesting to see if the Magnificent Seven, as they came to be known through this year, if we have similar performance next year, or maybe it'll be more of a year of rebalancing. Maybe we'll start to see maybe more of the Russell. Maybe the Russell will start to come back to life a little bit over the course of the next year. Obviously, it's kind of come to life quite a lot in the last handful of months, kind of finally breaking up into a new peak level in terms of this little trading range it's been in for a little while. But we'll see if maybe it can start to catch back up with the S&P as a whole. So anyway, that's going to do it for today. I appreciate you guys coming and chatting. We'll have another live discussion next week. And then, as I said, my plans for this week is to kind of try to go through sector by sector to do some pricing analysis. And then maybe we'll be able to actually pinhole on some really interesting underpriced opportunities within those sectors, and then maybe be able to find some interesting value opportunities within the underpriced. And then from there, we'll maybe be able to find a good opportunity for our next video, because obviously it's been a couple weeks since my last video. So I am expecting to try to put together some sort of good valuation video for you guys somewhere in the near future, but not quite here today. So all right, I'll catch you all next time. Bye.